Stephen Koukoulas is predicting higher interest rates. Let's have a look. Hello everyone, Florian Heiser here, and welcome to another episode of Heiser Says. Grab your stein of coffee. Let's have a look at this article from Yahoo Finance because, well, economist Stephen Koukoulas is predicting higher interest rates. The cash rate at the moment, and I will bring up this chart right here, which I haven't updated for some time, is at 0.1%. Now, I'm not updating it. Used to because I was a bit lazy. Now I want to see how long I can keep this whole chart like this and it still be accurate because, well, they're not lifting the cash rate. And there's, imagine if rates go up and we actually start earning some money on our cash. Wow, that'd be a novel concept. So, a higher interest rates on the way. Stephen Koukoulas weighs in. For the first time in many years, central bankers and global investors are witnessing a material pickup in inflation. Despite the evidence which shows inflation lifting to levels well above the target, the reaction of central bankers and investors has so far been muted. Well, is that because most people assume it's to do with supply issues and it will work through the system? We'll have to see. Some central banks have started to hike interest rates in reaction to the inflation pressures. Near to home, the Reserve Bank of New Zealand lifted its rates earlier this month by 0.5%. Some others in South America and Eastern Europe have hiked interest rates in reaction to the acceleration in inflation. Markets are now openly canvassing the prospect of higher interest rates in the US, Eurozone, the UK and Canada, among many others, perhaps within the next few months. So, up or down, China faces inflation conundrum. Weak demand has consumer price inflation cooling off in China, but prices for goods from China's factories are rising at a record pace. And the combination leaves policymakers with a dilemma. Numbers out Thursday showed producer prices rose 10.7% on the year in September. That's the highest since records began in 1996. Factory prices are soaring thanks to a power crunch that is raising energy costs. A months-long rally in global commodity prices also fueled the rise. But makers are struggling to pass on their higher costs to shoppers. Consumer inflation actually slowed last month, dipping to 0.7%. It was capped by weak demand for everything from clothing to household appliances. Food prices also fell. Now economists say the central bank faces a conundrum. Weak demand argues for further support for the economy, but soaring producer prices limits the scope for action. As a result, few expect any cut in interest rates. Some also see hints that consumer prices won't be immune to inflation for much longer. This week, China's biggest maker of soy sauce said it would soon raise prices by up to 7%. It says rising costs for raw materials, energy and transport make the move unavoidable. Bond markets, which inevitably move well before central bankers, have seen yields jump in anticipation of the inflation interest rate hike dynamics. The moves are relatively contained at this stage, but clever investors are looking for a further sell-off in bond yields once the penny drops more widely than that inflation is accelerating. In Australia, the RBA has largely dismissed these pressures, signaling that on its assessment inflation will remain low and it will not be required to hike interest rates until 2024 at the earliest. Markets are ignoring this guidance, with the start of the interest rate hiking cycle starting to be priced in to the later part of 2022, just 12 months from now, and around 2 years before the RBA reckons it will move. So the current cash rate is 0.1, as he's reminding us. The market is pricing in a 0.5% cash rate by the middle of 2023, 1% by the end of 2023, and with further increases through to 2024. If these rate hikes unfold broadly, as the market suggests, it will be after the RBA ends its bond buying program and the 0.1% yield target for government bonds dated out to 2024. Such a constructive policy change will only add to the upward momentum in bond yields, which will inevitably filter into mortgage interest rates, especially for fixed-rate products. Next week sees the release of the official Consumer Price Index data for September. It is likely to show a further increase in inflation, which the RBA has not anticipated. Indeed, the annualized increase in underlying inflation is likely to edge above 2%, a move that will see the banks revise up its inflation forecasts in the quarterly statement on monetary policy, which is scheduled for release in early November. At its board meeting on Melbourne Cup Day, the RBA needs to ask whether a 0.1% cash rate, aggressive bond purchase, and 0.1% target for the now 2.5-year government bond is consistent with the economic and inflation outlook. The answer is clearly no. At this meeting, the RBA would be wise to start flagging the end of all of these policies and to lay out an up-to-date and realistic timetable for what will be inevitably tightening in monetary policy. It can easily scale back and then turn off the bond buying program. So too for the target for April 2024 bond, which can slowly step away, allowing those yields to be driven by the market. In terms of hiking the official cash rate, the RBA needs to signal to the market that inflation pressures have been more acute than it was forecasting even a few weeks ago, and it will follow the lead of other central banks pointing to the need for higher interest rates in months ahead. Not only would that be prudent from an overall inflation management perspective, but it may have the benefit of cooling demand for credit, which has fueled the recent boom in house prices. Such a move would be more powerful than recent decision of APRA to tighten lending rules for mortgages. There are 2 meetings of the RBA board before recess for early December 2021 through to early February 2022. These are the windows for it to be proactive in its policy guidance strategy and signal, well in advance that the days of easy money are about to end. What do you think, everyone? Let's have a bit of a talk about Koukoulas' warning here. One thing I think we can all agree on is simply signaling from the RBA will have a greater impact than anything APRA is going to do. Now, what would happen if interest rates start to go up? Well, some people are hoping it'll be a calamitous correction in the housing market. It'll probably just cool it a little bit. Cash is so cheap. People have liquidity buffers. People have paid ahead on their mortgages. They're going to be fine. Most of the banks have accounted for increased interest rates. You've got a 2.5% to 3% buffer in their calculations. You should still be able to get by. Some people, it may take a hit on the consumer spending and the luxury items that people buy, but it's not going to flow through to the market with regards to housing, I can imagine. Sure, there'll be some that are right at the edge. They're going to be tipped over, but they would have been in trouble months ago or a year ago, and we didn't really see calamitous fall then. If anything, we saw intervention and the government and state come to the rescue. Now, will the RBA take Koukoulas' advice, or will they just, keep hoping that this inflation that we're starting to see is transitory and will work its way through? We'll have to watch and keep an eye on. As someone sitting back and watching, I locked my mortgage in at a lower rate. I didn't think it would get much lower than that. We'll have to see if that was a good move. And probably knowing my luck, I'll jump right out of that mortgage to nice high interest rates. But at least the positive is we might be able to earn some money on our savings. Isn't that a novel idea? Anyway, guys, let me know your thoughts and opinions on this one in the comments down below. Thank you for watching. If you enjoy the content I find and put together here, there are a few ways you can help out. You can sign up for the live channels on YouTube or Twitch. Support us financially via joining on YouTube or Patreon. Sign up using our referral links to Self Wealth or Stake. Buy our merch from Heiser Says. Use our other referral links from Amazon, eBay, Independent Reserve, or Aussie Broadband. Buy our merch from Heiser Says, as I've already said, or help us out using Gold Pass or PayPal. Take care, and I'll see you all next time. Bye for now.